Hello everyone. In this video, I will talk about some more cash flows except sunk cost, opportunity cost, and side effects. These cash flows, we've seen that before, and I just officially answered the question that why we should include those cash flows into our cash flow from assets calculation. So the first is changes in net working capital. We know that cash flow from assets equals to operating cash flow minus changes in net working capital minus net capital spending. So net capital spending is really easy to understand because you spend some money to buy fixed assets. And some people may ask, why should we include the changes in net working capital in the calculation? In chapter 9, we briefly mentioned that changes in net working capital basically is the cash that we use to acquire current assets, short-term assets. I use more examples to illustrate that. So here, a project will generally need some amount of cash on hand to pay any expenses that arise. In addition, a project also needs an initial investment in inventories, raw materials, and account receivables to cover credit sales. Because if you sell your suppliers, you sell your products to your customers, sometimes customer cannot pay you immediately. They may ask you for credit lines and pay you within 30 days or 60 days or 90 days. This part is in the accounts receivables. So in this case, you actually have the revenue, but you do not have cash inflows because you haven't received those cash. So some of this financing will be in the form of amount owed to suppliers. So if you buy raw materials, sometimes you will pay your suppliers later. So you have cost of goods sold, but you do not have a cash outflow, actual cash outflows. So we put that part in accounts payables. So those are represents the investment in net working capital. As the project winds down, the inventory are sold, receivables are collected, bills are paid, and the cash balance can be drawn down. So those activities free up the net working capital originally invested. So the firm's investment in project net working capital closely resembles a loan. The firm supplies working capitals at the beginning and recover its toward to the end. So if you just read those, it's really hard to understand. I will use some numbers to illustrate that. Why we consider this change is because we have these Australian accounting standards which include matching principles. So the matching principles requires that we record the cost of goods sold when we have revenues. But sometimes we probably do not pay the cost, pay our suppliers. And sometimes we buy inventory to support sales, though we haven't collected cash yet. So those we have to put in our income balance, but we do not have cash outflows or haven't received cash inflows. So we need to factor in those stuff to calculate the cash flows, not the accounting numbers. So suppose during a particular year of a project, we have a sales of $500, cost of $310, depreciation and taxes are zero for simplicity. No fixed assets are purchased during the year. So the operating cash flow equals to EBIT, add back depreciation, minus taxes. So basically it's 190 days. So we have sales minus cost is 190 days, and which is earnings before interest and tax. No depreciation, no taxes. We assume that only components of net working capital are accounts receivables and payables. The beginning and ending amount of those accounts are above. So accounts receivables beginning of the year is $880. Accounts payable is 550. So the net working capital is $330. The end of the year, accounts receivable is $910. Accounts payable is $605. The net working capital is difference between accounting receivables and accounting payables. So the net working capital is $305. So we found that the changes of net working capital is negative $25. The cash flow from assets is what? Operating cash flow, this is 190 days. Minus net capital spending is 0, and minus this negative $25, so it's $210. Those are cash flow from assets. Use our formula. And let's break down into cash inflows or cash outflows. We have sales of 500, but this 500 is not cash inflows. Accounts receivables rose by $30 over the same time period, which means that we haven't received all the cash flows for this 500. Out of this $500, $30 that customer didn't pay, haven't paid to us. So the customer may pay next month or next 3 months, but we don't know. So there's $30 we didn't collect it back. So the cash inflow is 500 minus this $30. That is an increase in account receivables. So it's $470. Cash outflows, the cost is $310. Those are cash outflows. Not all those $310 are cash outflows. Accounts payable increased by $55, which means that we have not paid this $55 out of this $310. So the cash outflows should be the difference between these $310 and the $55 that we haven't paid. So the cash cost or cash outflow is $255. Put this together, the cash inflows minus cash outflows, that is our cash flow from assets, is $215. So those two numbers are exactly the same. One more example. So for the year just calculated, the Combat Wombat Telestat reports a sales of 998 and the cost of 734. And you have the following information. So right now we include the inventory. So what's the cash inflow, cash outflow, and what's the net cash flow? Cash inflow, first we have a sales of $996. So those are, at least the majority of them are cash inflows. And we found the account receivable rose by $10, which means that we haven't collected $10 from our customers. So we minus this $10 increase by the accounts receivables. We found out that the cash inflow is $988. The cash outflow, first we start from the cost of goods sold, which is $734. And the inventory falls down $20, which means that we didn't replace this $20 inventory. So cash outflow, we buy less, so which means we use the inventory we buy the last year. So that's less cash outflow. So the cash flow is lower than the cost by $20. So those $20 cost, actually we use what we buy in last year. What we bought from last year. So we save $20. There's less cash outflows here. Accounts payable falls by $30, which means that we actually pay our suppliers $30 more than we received from them. So in this case, cash outflow is higher than the cost by $30. So the cash outflow is the cost of goods sold minus this $20, because that's part of even raw material we used. We use used to produce our products, but those parts we actually pay our suppliers in the past year. And then add $30, that is account payables. Account payables fall down by $30, which means that we pay more than we to our suppliers. So it's 744. The cash flow from assets will be the cash inflows minus cash outflows is $244. The net working capital increased by $20 overall. So operating cash flow is the sales minus cost is 264. And there's no net capital spending. So if we use our formula, cash flow from assets is 244. It's exactly what we get here. So we use this formula just to try to simplify the calculation of cash flow from assets. After we calculated the free cash flows, we know the financing cost, which is the weighted average cost of capital we calculated, we learned in chapter 8. And then we need to know taxes. Then basically we can get our free cash flows, or so-called cash flow from assets. Next thing I would like to introduce is this tax shield approach. So we know cash flow from assets equals to operating cash flow. Remember, cash flow from assets equals to the operating cash flow minus the changes of net working capital minus net capital spending. And then you can find out the operating cash flow using, this formula. Earnings before interest and tax, add back depreciation and minus taxes. We can write these taxes as earnings before interest and tax multiply tax rate if there's no interest. And then we can put these two together. So we can merge the first term and the third term. So it equals to earnings before interest and tax times 1 minus tax rate. And add depreciation. So earnings before interest and tax equals to sales minus cost minus depreciation. So we can rewrite this formula as sales minus cost times 1 minus tax rate. T is a tax rate, and minus depreciation times 1 minus tax, and add back depreciation. So then we can combine those two terms. So those two terms equals to depreciation times, this is negative 1 minus t, which is negative 1 plus t and plus 1. So those 1 will cancel out. So the second term becomes to depreciation times tax rate. And this part is called depreciation tax shield. So this is particularly useful when the major incremental cash flows are purchase of equipment and associated depreciation tax shield, such as when you are choosing between two different machines. You should know the machine with higher depreciation amount will have higher tax shield. Next one, I would like to introduce depreciation. Depreciation expenses, we should first know the depreciation schedule. What is the depreciation schedule? It's like at each year, what's the depreciation of that equipment? Again, the depreciation is a non-cash expenses. The cash flow actually happened when the firm purchased the equipment. The depreciation tax shield equals to the depreciation expenses times marginal tax rate. The reason the cash flow from assets is related to depreciation is that the depreciation has its tax shield. It will, because of the depreciation tax shield, it will increase the cash flow from assets. So there's two types of depreciation schedule. The first one is called straight line depreciation. It equals to the initial cost minus the salvage value. Salvage value is the value left after the useful life of this equipment, divided by numbers of years. And many assets are depreciated straight line to zero, so the salvage value here, the salvage value equals to zero. The second one is called diminishing value depreciation, or we also call modified accelerated cost recovery system. This is a depreciation system used in US. We will introduce this diminishing value depreciation later. It's a fixed table. You have to use that table, the depreciation rate of that table. So this is the modified accelerated recovery system table. So you need to know which tax rate is appropriate for tax purpose, and then you multiply the capital spending or capital expenditure with a percentage in this table. So it will always depreciate to zero. So if the equipment have the 3-year useful life, and the first year the depreciation rate is 33%. The second year is 45%. Third year is 15%, and the fourth year is 7%. It is a 3-year depreciation schedule, but it depreciated over 4 years. For a 5-year depreciation schedule, it depreciated from over 6 years. And this is the table again is fixed, it's given. So calculate the depreciation of this 20,000 equipment. Use the modified accelerated recovery system. This is 3-year rate. So use this 3-year rate. So we should know the capital expenditure is 20,000. The first year depreciation, we use this because it's 3 years, so we use this column. The first year, the depreciation is 33% of this 20,000. It's 6,600. The second year, the depreciation rate is 45%. So the depreciation is 45% of this $20,000 US dollar is 9,000. Third year is 15,000 of this 15% of this 20,000. So the depreciation is 3,000. And the last year, the depreciation is 1,400. Add it up, it will be 20,000 US dollars, which is the capital expenditure. I think I will stop here. Next video, we will talk about the salvage value. I try to keep the video short, and see you in next video.